What is going on, you guys? Happy Friday. I think what I'm going to do, so this is the first time that I ever streamed on both X and YouTube before. So, what I'm going to try to do is what prompted this is that I had a Savvy Trader subscriber recently ask about like how do I think about like portfolio diversification. So portfolio diversification is it's mine's a little bit different, right? And you guys can actually see that on the screen is that I usually own about 20 or so stocks when a lot of the other growth investors that are out there, they own somewhere around, I think that like Saul's investing group will own somewhere between 5 to 10 stocks. Some other traders and investors, what they do is they actually end up owning a little bit more like, maybe 15 different companies, but their allocation will be a lot higher. So you guys can actually see that my portfolio allocation to a lot of these companies, none of them is over 10%. So that's actually what I wanted to talk about here today, and more or less even like talk about like how I think about the business and how I think about investing returns over time, especially running a growth portfolio. So what I wanted to do is just probably talk for about 30 minutes, really just talk about like what the investing process is, what I'm thinking of long term, how I'm diversifying out my portfolio, and more importantly, how I'm even managing risk in the first place. So uh, I think I think what I wanted to do is actually just talk about like what my portfolio returns are so far. This is so I opened up this portfolio, my Savvy Trader portfolio here in January 15th. So it's been over a year now. And you can actually see that so far I have outperformed the stock market. This is the Nasdaq, and you guys can actually see my portfolio returns over the S&P 500, which is pretty substantial. This is pretty indicative of what you're going to see with most growth portfolios if you're picking stocks correctly over time. Because what it is like if you think about like the S&P 500, it's basically 500 biggest companies in America. But usually only a couple companies are going to outproduce or they're going to produce more returns over time. And the way that I really look at this is yes, I do incorporate technicals, but I don't trade. I do invest in a lot of the companies, and you guys can actually see a lot of my returns here where I've actually hit a couple one baggers publicly that I've shown so far, where you can see Zscaler, Palantir, some of my biggest returns. And I actually think that I can do this. So you can see some of the biggest returns I've had, like even Sentinel One. Monday was a good one, and a couple other companies. Some of them are not so great, like Tesla right now. I think Tesla is actually going to be one of my worst performing companies on adding to Tesla, especially during this time. So what I think that I'm going to do here is I'm going to actually talk about portfolio diversification. I'm going to use a couple of Brian Feroldi images here. So once again, going back to that diversified portfolio over concentrated portfolio. And now this is just my philosophy, right? I'm not saying that there's a right or a wrong way to do this. It's really just talking about like what I've found over the years that I've been investing, what works out best for me. So for context, like I think Peter Lynch actually ended up owning hundreds of stocks at any given point in time. And what he did is he tried to consistently pick multi-baggers or like 10 baggers, as he usually liked to say. And with these 10 baggers, essentially, they were going to be smaller companies, not always larger companies, but I do think that there is something to be said about owning larger companies like Amazon, which had a fantastic earnings today, or even Microsoft. It's been a fantastic investment, even especially like if you owned it back in 2015, 2016. A lot of those companies are doing great, but it really depends on like, is the business going to be able to outperform over time? And the way that I look at it is that with my portfolio returns, and this is once again Brian Feroldi, I got to give him a lot of credit. I'm going to talk on a couple of these things here. The best way to think about it is like there's going to be periods of time where when the stock market goes down, my portfolio is going to go down. And I think that that's usually what people get really caught up on is sometimes like those portfolio drawdowns, so like today, everything is rosy. But if you guys can recall back about a year ago during that January 15th, like I mentioned, so like that November, probably to about early January 2022, 2023, was a pretty bearish time. And there was a lot of people that I don't necessarily know why investors behave this way, but usually when stocks are heavily discounted and way below their intrinsic values, people just cannot sell them fast enough, and they just believe that something about the business is broken. But that's not necessarily how it works, because there is some times where sentiment does swing in a certain direction. And right now, I think that where we're swinging is probably in a little bit of a euphoric market. But I mean, the valuation still makes sense. I see a lot of analysts increasing their expectations, and I mean, it's pretty crazy time to see that kind of swing in sentiment. And that's always what I talk about, like not chest beating. So I think I posted about that today, where it's like people sometimes get really excited when they hit these peaks, and you can see that peak right there, and they get really excited and they say like, oh, I'm doing super great. But then as soon as your portfolio goes down, and maybe it even underperforms the market periodically, and you guys can actually see, I'll go back to my savvy trader here, where there's these moments where, when you run a higher beta portfolio, you are going to have swings that are probably a little bit more than the market. And that's okay, because what it really comes down to at the end of the day is that over time, your equity curve does start to smooth out. So like right now, that's only 1 year of data, but over time it's going to start to smooth out, and then you're going to actually start to see my real investing returns over time. And the best way to think about that too is like oftentimes the stock does oscillate pretty heavily in between, oversold and overbought conditions. And what I try to do is I try to focus on actually buying these companies at discounted valuations. So like the Trade Desk was a recent buy that I had. I've been buying a lot of Tesla recently. I think that I bought MongoDB when it came down to a fair valuation, not a low valuation, but a fair valuation. DraftKings, same thing. And the reason why I do that is that I'm really trying to figure out like what's the overall margin of safety. And from a growth stocks, I mean, these growth stocks are wild. Like their volatility is just always going up and down, up and down. I mean, it's sometimes the stock, like for instance, like today, Meta was up like 20%. Excuse me, this is a live stream here. So I sometimes when I talk, I just get a little dehydrated. But sometimes these growth stocks, they'll run 20% in a day. But then simultaneously, they'll also actually drop like 20% in a day, especially after earnings. Like Tesla recently sold off. I think it's down about 25 or 26% year to date. But if you look over the 5 year returns, I think it's somewhere around 500 or 600%. So it's some crazy market outperformance. But at the end of the day, it's like what's Tesla's business doing, and that's what I really try to focus on here. And I thought that Brian Feroldi made this ingenious graphic right here, where the stock price does oscillate around the business's intrinsic value. So like when you are doing a growth investor approach, making sure that you are always ready for that volatility is like the number one thing to always think about, right? And that's how I've really come to learn this, is like, hey, sometimes there's going to be periods of time where the business is undervalued. Sometimes it sells off. Sometimes it sells off 10, 15, 20%. Because of whatever, I don't know why this happens, but sometimes people think that the stock price is the business. And sometimes when the stock price does go down, it's not always because of the business, is like the overall trend of the business is underperforming. But what ends up looking like over time, and like with stocks just in general, over time the market goes up. And the reason why the market even goes up in the first place is just because corporate earnings are going to continue to grow. So the name of the game is really not necessarily about avoid the volatility, because I mean, yes, do you want to make sure that trying to buy high and then sell low or whatever? Actually, the other way around, sell high and then buy low is obviously what a lot of people are trying to accomplish. And there's all sorts of different complex technical trades that you can do. Some are really good. Mark Minervini claims that he's really great at it. Some people can time the market. Some people claim that they can time the market, but will never ever show you their portfolio results or even talk about that they can do that. What I've found is that over time is that businesses are sometimes cheap and sometimes they're expensive. And being able to identify when they're cheap or expensive is the name of the game. And because what it is, it's not like when you sell that you make money. It's really when you buy. And the way that I really look at a lot of the businesses that I own is that each and every single one of them are going through a type of life cycle. So like a lot of the businesses that I'm shooting for are actually going to be in this category right here in this growth curve, where they don't always have a lot of cash on hand. And I really try to find these. So like I would say Tesla's probably a little bit further along in the growth, maybe even in the shakeout period right here. But the life cycle extension is what I'm really thinking about is like, that's going to be the FSD or Optimus or whatever it might end up being. But with a lot of let's go back to some of the stocks that I own. So you can see some of the stocks that I own, like, let's go back to here to return, like Zscaler, Palantir, Datadog, Sentinel One, AMD. Like AMD is probably one of the biggest companies that you see right here, which is, I think it's a $200 billion company right now. But a lot of these companies are under $100 billion market cap. I think Zscaler is like 30 or 40 billion, which is pretty big. And then Palantir is right up there too. But I even have some small caps, and you can see that with like Indie Semiconductor and Navitas and D Local and then Confluent. I don't actually own too much of that. You can see that the portfolio allocation is about 0.04%. I'm not 100% sure on that business. Anyway, but what I really try to do is I try to find a lot of these companies that are going to be earlier in this growth curve. So the reason why these businesses oscillate so much and why they're so volatile is that funds and institutions and investors, what they try to do is they try to guess like what's the cash flow actually going to be over time. And that's a tough game to play because it does oscillate along the lines of like interest rates. So like what is the discounted cash flow based on interest rates? And that's a way that a lot of these institutions have set up their how do I say this? Like their projections, their models. Yeah, the models is probably the best word that I'm thinking of. Is like, so they try to set their models to gauge out like what the accurate price of the stock may be. And a lot of them do a discounted cash flow mechanism, but sometimes with these businesses, especially when they're growing really rapidly, they don't always maximize for profits right away. I think the best example right now is actually Amazon, where Amazon, it grew and it actually had negative EPS in 2022, but you can actually see that the earnings per share has been relatively low for a long period of time, but they have been in growth mode for a long period of time, where they've actually seen like 20% prior to this year and prior to 2023. They saw like 20% plus growth in their AWS, which is their highest margin business. And even like their e-commerce business right now too, they're still investing so heavily that they don't actually have that much cash or profits on hand right now, or cash or profits to show for that business investment. But once they actually reach the scale that they're trying to get to, then that's usually when they start optimizing for profit or cash. So a lot of these businesses, they do end up looking a little bit more expensive than what you can actually what makes sense on a forward PE basis. But that's because of how early they are on their life cycle. And then that earliness in that life cycle actually creates the volatility in the stock, because it's very hard to be able to project out like, what is this business actually going to be able to produce once it reaches that maturity? And that's the best way to think about stock valuations. But in addition to that too, it's like with outside of the stock and outside of like the overall like earnings results that are produced, the stock market does go through these crazy periods of like euphoria. So I would say that like we're probably somewhere here in the investor emotion cycle where I don't see too much euphoria, but I definitely see optimism and thrill, which is not necessarily going to be the area where I'm thinking, okay, this is a great time to go heavily into stocks, or like it's time to start buying, or whatever it might end up being. But down over here is probably that 2022, that late 2022, that early 2023 time period where there was that panic depression and then borderline relief, like that, let's say March, April timeframe. But during those periods is absolutely like you got to be thinking about from an investor. It's like, when is everybody depressed? When are stock multiples really low? When are expectations of future revenue or future earnings growth going to be really low? And then that's because it's really good to buy during those times. I mean, I think it's kind of common knowledge. Everyone always knows exactly why you want to buy during those times, right? Because that's when stock prices are the cheapest. But it's actually really hard to execute over time. But there's a couple different things that I use to really gauge out exactly like what I'm paying for the price of the stock. And I use Seeking Alpha quite a bit. Let's just look at AMD for right now. Actually, let's look at NVIDIA, because everyone loves NVIDIA. So NVIDIA, this is something that's been really interesting that I've seen recently. And we can actually talk about like where it's at in the market cycle right now. So over the past year, a lot of people haven't been paying attention to this, but analysts have been consistently revising up their expectations for NVIDIA, not just from a revenue perspective, but also from a PE perspective. So like right now you can see that, and this is exactly why I think I was on a Twitter Spaces earlier, and they said, or X Spaces, and they said that it's funny that after the stock price rallies, that's when the stock price actually looks the cheapest. So you can see that the forward PE ratio right now on Nvidia is actually 30, but that has a lot to do with analyst expectations. And it wasn't just the other day that I saw that the revenue expectations for this year in 2024 was somewhere around like 60%, but now people are thinking that it's going to be about 120%, right? And that's exactly what creates all this volatility. And this equation, these expectations can flip completely on the other end of the cycle, where that extreme pessimism can really kick in, and analyst expectations get revised downward. And that's exactly like what's going on with Tesla right now. So a lot of people think that Tesla is going to be, now it's extremely. I think I am sharing this one. Okay. Yes. Let me just double check here because, like I mentioned, this is a live stream. All right. Going back to Tesla. Okay. So you can actually see Tesla in a lot of their earnings expectations here too, where now all of a sudden they're thinking to themselves like, and this, it wasn't too long ago where they actually thought that Tesla was going to grow 20% plus this year. Now they revise it down to 15%. And I guarantee you that if interest rates end up falling, or if they have like one good quarter, this is going to completely flip on the other end. And that's what creates so much volatility in these growth stocks. So I think that like it's very important because I got to make sure that I go back to exactly what I was talking about in the first place, like with portfolio diversification. The reason why, knowing this information and knowing that everything works in a cycle from like an investor optimism and an investor pessimism, and knowing that everything moves on analyst expectations or Wall Street's expectations, and that this oscillates based on quarterly results is exactly why I do diversify out my portfolio a lot more than a lot of other people, because there are going to be periods of time where like stocks, it's like Nvidia, as much as people want that stock to never ever go down because it's basically been up and to the right, there is going to be a point where analysts come out and they say, oh, maybe they're not going to grow 120% this year. Maybe it's going to be a lot more like 70% this year. Or maybe maybe they're not going to grow 56% next year. Maybe they're going to grow like 30% next year. These are often the times when you actually see the stock price plummet. And this creates extreme volatility in somebody's portfolio. And not only that, but it also like people can get blown out. So like I remember that a lot of investors during 2022, they did capitulate their stocks and they sold a lot of their stocks, and a lot of them were running these high growth, high concentrated portfolios. And sure, maybe that did work from 2018 to 2019. I think that this tab is actually going to be really important to show. So maybe that did work from 2018 to 2019, because you can actually see that that basically the valuations in the S&P 500 were super compressed from 2009 all the way up to probably right about now. But you can see a lot of those multiples were super compressed. So what we've really experienced in this bull market is not only just like earnings growth, but we've also seen massive multiple expansion. So during periods like this, where interest rates are low, the economy is chugging along, and multiples are expanding, there is a lot of forgiveness when people are thinking about like, okay, should I pay attention to multiples? Should I not pay attention to multiples? Should I pay attention to the market cycle or not pay attention to the market cycle? There is like this 10 to 20, maybe 10 to, probably 10 or 12, 13 years where that didn't really matter, because the economy was still recovering from the 2008 global financial crisis, where today that is not the case at all. And that's exactly what ended up happening in 2022, is that we had these insanely high multiples during that period. And especially in software stocks. I think that I got to go to jamming balls here. So like a lot of those concentrated investors, they did really focus on those high growth, those software stocks that were, growing 60, 70% year over year. And during this entire time, so this actually puts better context on that. During this entire time, you really experienced a lot of that multiple expansion. So of course, this is going to work because the market's being forgiving. There's low interest rates. The economy is chugging along. It's not really going through a recession, not really going through periods of high inflation. So the Fed was always accommodative during that time. But historically, if you look back like 100 or 120 years in the past, that hasn't really been the case. So now what ended up happening is like in 2021. So you can see in 2020. So this is the COVID market crash right here. In 2020 and 2021, we experienced this period of rapid multiple expansion. And this is where people really, really got hurt because they thought that because stock price go up, that is good business. But paying attention to those multiples and then also making sure to not always buy those high flying software stocks or growth stocks and overly concentrating in on those, you're going to manage a lot of the risk. And even like I mentioned with like NVIDIA these days, right? Or a lot of the other AI companies like AMD could potentially be one, or Meta. I mean, Meta I think is actually probably pretty undervalued compared to what it could do especially as they expand out their bottom line. But it's really going back to like knowing and understanding that market cycles do exist, and knowing and understanding that a lot of these stock prices do move based on analysts' expectations, and also knowing and understanding that there's going to be a period where the macroeconomy does not favor exactly what we're going to go through, or the macroeconomy doesn't favor, how should I say this, like stock prices continue to expand their multiple, that we will go through periods like 2022. And during those periods, typically those high growth stocks, so like this right here, this contraction of the multiple doesn't even do it justice. What actually ended up happening too, so like, I think I got to find out exactly, and this is going to be at the top of it. So right here, when we went back to, and this is all the way back at 2021, where a lot of these top 10 growth stocks, so this is the chart that I was looking for, these top 10 growth stocks, a lot of them had a next 12-month revenue growth expectations of somewhere around like 40, 50, and 60%. So when you go through periods like that of multiple compression, and then also revision down in the next 12-month expectations, what ends up happening is that you end up getting blown out. And making sure that you're diversified and not always just being in the hot stock that runs because it's expanding its multiple, or because the next 12 months earnings revisions have been revised up and up, and making sure that you actually do run a portfolio where sometimes there's going to be stocks that are currently laggards. So like, let's go back to Tesla. And I keep hitting on Tesla because this is the one stock that I think is actually a really good buy right now. So you can see that during, like in these pluses, these plus signs, and then the lines, those are the areas that I've actually been adding to Tesla. So you can see that historically I've been adding them when I think when Tesla has gone down, or when I think it's close to a bottom. So I'm pretty good right there, and pretty good in this area. And then even right now, and then right here too. Making sure to actually take advantage of what the market is giving you, and not always just sticking with the hot stock, is going to, what I believe, and what I've experienced so far, is going to be the thing that actually leads to outperformance over time. Because every now and then, every investor, so like for me, Palantir, right? So you can see that going back to here, Palantir, I mean, that was a total, you guys can actually see where I started buying Palantir right here, where I didn't think that it was going to run, where I was going to double in like a couple of months, but the expectations were super low. Everyone thought it would never be profitable. But it was during one of those time periods where it's like everyone was super bearish on Palantir, and it wasn't the hot stock during that time, especially in the beginning of 2023. But for me, in that particular time, I knew that it was a good business. I knew that expectations were really low. I knew that the multiple was fair, which did end up leading to outsized portfolio returns. And I think Zscaler is also a great example. And you can see where I started buying Zscaler. During this time, this is about the time where the Gartner Magic Quadrant, this one right here, the Gartner Magic Quadrant ended up coming out. And then what ended up happening was that, like, is it Netscope? I don't know. It might be Netscope or something. Netscope ended up taking the leadership position in the Gartner Magic Quadrant. Everyone was just like tripping over themselves, saying that Zscaler was going to go bankrupt. And it was like, guys, this company has like a 20 to 25% free cash flow margin. They're growing 30, 35, 40% year over year. Like, this doesn't make any sense, but sentiment swung so far in the other direction. If you ran that concentrated portfolio and you didn't necessarily think about buying those undervalued stocks, you probably, I think that a lot of people actually ended up selling Zscaler during that time rather than just paying attention to the business. And that's really the best way that I think about from like a diversification perspective. I really try to hit like that 20 stock limit. So like I don't really like holding anything less than 15, and I don't like holding too much more. I mean, maybe I'll hold like 21 or 22 positions, but you do get to this point where if you overly diversify your portfolio, it's Peter Lynch's favorite word is diversification. Eventually, you do start to saturate your returns with companies that could potentially underperform. So like we'll go back to my portfolio here and we'll actually look at some of these bottom performers like D Local, Indie Semiconductor, and Navitas. So all three of these right here have drastically underperformed the market. But D Local, I mean, going back to my current philosophy is like, hey, if they're growing revenue, earnings, and cash flow, like maybe I should buy more of this company. But from my perspective, I'm thinking to myself like, hey, the business thesis is still good. I have the current amount, like my current portfolio percentage, where if it does go lower, it's not going to kill me. Same thing with Indie Semiconductor and Navitas. These are both long shot plays where I'm thinking to myself like, hey, if they end up going to zero or if they go bankrupt or whatever it might end up happening, or if things just don't work out, it's not going to be a devastating thing for my portfolio. And even like the high flyers out there too, like the trade desk. So the trade desk has always been expensive, but it does have periods of high volatility and periods where the multiple is going to contract or the next 12 months growth expectations are going to contract. So think about it as like a cycle, is that I'm constantly always thinking about like what companies are going to outperform over the next 12 months or 2 years based on the multiple and based on the current expectations. And sometimes those high flying growth stocks, like the 5 or 10 stocks that are just absolutely hot right now and just can't get out of their own way and they're constantly expanding their multiple, like during those periods of time, like sure, it sounds smart in the moment, but to make sure that I'm managing risk on the downside, I'm constantly thinking about the next companies, the next couple companies that I think could actually outperform. And another example I can use is actually going to be Sentinel One. So you can see when I bought Sentinel One right here in this April timeframe, and then right after the earnings ended up selling off, and I just held it for that entire time period before it actually became one of my biggest winners. And you can see that it's only 5.87% in my portfolio, but the returns are going to be 82.87%. Once again, going back to like if I ran that high concentrated growth portfolio, it doesn't allow me to actually have. So like if I only owned the 5 or 10 best stocks that had the best technical setup and had the best, like earnings outlook or whatever it might end up being, the best sentiment, then I wouldn't have a lot of these returns. And even like Monday too, you guys can see a lot of the times I ended up buying Monday right here, where I actually ended up buying it. I think this is right before earnings is when I bought this one, right around here in this 150 area and 150 and below. And now it's turning out to be one of my best performing stocks. But that was also not one of those, high flying companies that everybody wanted to buy. So the way that I really look at it is more or less like, how am I making sure that I can consistently set up my portfolio? And I found that 20 stocks is actually some of the best ways to be able to manage risk, because like you are going to have your Teslas out there where they are going to underperform during a period of time, or even like AMD here too. There was, I mean, a 1 year chart doesn't do it justice. Actually, it does. So you can see right here when I was started buying AMD, all along this area right here where it's like, hey, I think the AMD is underperforming. I think that the MI300X is going to come out good, but it's once again, it's not one of those high performing stocks, but it returns 60% for me so far, and I think that it even still has room to run, especially as we head into 2024 and 2025. So I do hope. I know that we're at about 30 minutes right here. I'm gonna go back here and check. So I want to answer some of these questions. I've been buying C at 35. What are your thoughts on that stock? I think that C Limited actually has a lot of problems right now. So C Limited, what people aren't talking about is that it was about 2 earnings reports ago that they actually reported revenue growth of like 15 or 20%. They expanded out their GAAP PE, but they didn't report their GMV. The reason why they didn't report their GMV is because I think that they were actually hiding it, because that's actually the GMV is actually the real sales on their platform. So what they could have done is they could have jacked up the prices on a lot of their products or for their customers, and they could have actually cut a bunch of costs all at the same time to, on paper, make their revenue and earnings growth look really great, but the GMV would have actually been the thing that signaled like what the overall growth is, and more importantly, like how it's performing against their competitors. Right now, I haven't seen anything from C that would actually say that, like, hey, maybe it's time to actually buy this. Hold on, my dog's about to start barking. Don't. Sorry about that. There's probably somebody at the door. I think it's probably the Amazon guy. I should definitely own Amazon stock. How do I calculate intrinsic value, i.e., the fair price you're willing to pay? So the way that I look at it really depends on the business. So going back to Jam and Balls example here, where a lot of these software companies, they do trade on the next 12 months EV to sales ratio. But what I've noticed and what everyone can probably see here is that a lot of these higher multiple companies, they have a positive free cash flow margin. So knowing the software market, historically, if they have a positive free cash flow margin, then they are going to be valued at a higher, they're going to demand a higher multiple. Somewhere between what I've noticed is about 10 to 15. So that's how I value software stocks is like, number one, what's their free cash flow margin? And if they have a positive free cash flow margin, especially in the 20% area, then I'm thinking like 10 to 15. But what I'm usually using, so like I think that Shift 4 is going to be a good example. So we'll go back here to Seeking Alpha. Shift 4, I actually use PE ratios for some of these companies. So Shift 4 is, I think, a very undervalued company right now, where in 2024, they're expected to grow 44% this year, but their PE is only 19.58. So it really depends on the company that I'm analyzing, because software companies do demand that EV to sales multiples. And but a lot of other companies, I am using that PE ratio. And you guys can actually see like D-Local, which is one of my underperforming companies. So D-Local is trading on a PE ratio of like 21 this year, which is super undervalued. So that's how I'm thinking about that. I do think that when I'm analyzing companies and actually making sure that like I'm paying a fair price, the rule of thumb is the further down the income statement that you guys can actually get, the better it's going to be. So Indie Semiconductor, that was the next question. Any thoughts on Indie? I like Indie, but we got to make sure. I do think that it's being tied up right now, and we'll go to that multiple. I do think it's being caught up right now in the car market. So like what I notice is that Tesla and Indie, they kind of, I don't want to say they absolutely move together, but they kind of move together. But Indie Semiconductor, they're a semiconductor company that sells primarily into the automotive market. And right now, the automotive market and the automotive market stocks are being treated, I don't want to say unfairly, because the market right now is just a complete disaster. But Indie Semiconductor right now, they are transitioning from un-GAAP profitability to GAAP profitability. You can actually see that right here in the PE ratio for the 2025 timeframe. I think that Indie Semiconductor can be one of the best performing companies in my portfolio this year, especially if they hit that GAAP PE. So if they actually hit profitability, I think that it's going to be a really, really big winner, probably in the second half of this year. But I think that right now, Wall Street, they're usually really slow on actually, they're really slow on being able to like find these smaller companies. So like Global E is another example. Global E, I was like buying at 13, 14, 15, and then even $20 per share. But it took a long time for Wall Street to pick up on that one. I think Indie Semiconductor is going to be one of those. And then once they hit profitability, I think that Wall Street's not going to be able to sleep on them anymore. But that's obviously going to happen when it's meant to happen. I do think that Monday, that was the other question here. I do think Monday looks really great too. So Monday, I think I can actually show you guys this on my Savvy Trader. So we'll go to Monday, and on my Savvy Trader, I always run multiples, so you guys can actually see how let's go share this tab, and I ran the multiple right here. Where on December 17th, after all the earnings season, I do this every quarter, where I actually ran a lot of like the multiples on it, and I said, these are the analysts' expectations right now. Monday's trading on this enterprise value to sales ratio, but they have 25% free cash flow margins. If they were to trade at 10 to 12x, this implies that in short term, it would actually trade up somewhere between 213 to 257 per share. That was posted in December, and then today it's actually trading at 214 per share. So I still think that it has room to run, especially if it hits that 12x sales multiple. But then at the end of the year, I do think that it should hit somewhere between 274 to 329 based on their market cap. Looks like I don't have any more questions, guys. And I've been on the live stream for about 35 minutes now. Never hesitate to ask any questions. You guys can always reach out to me on X or on YouTube, and feel free to comment below. There will be a copy of this on my YouTube. Have a good one.